What if the reason your Forex strategy keeps failing isn't because you need another indicator, another secret entry, or another complicated system? What if the biggest difference between struggling retail traders and professional market participants is simply how they understand price movement? Today, I'm going to show you a simple framework based on liquidity, market structure, displacement, and price behavior that can completely change the way you look at a Forex chart. And before we go any further, forget the idea that banks have a magical secret indicator that predicts every move. Professional institutions deal with enormous orders, liquidity requirements, execution problems, risk, and market structure that is very different from what a small retail trader experiences. But by understanding where orders may be concentrated and how price reacts around those areas, you can begin reading the market from a much more intelligent perspective. Most beginners are taught to search for the perfect entry signal. They learn candlestick patterns, RSI, MACD, moving averages, trend lines, support and resistance, and then try to combine everything into one complicated system. But here's the problem: an entry signal means very little if you don't understand where that signal is happening. A bullish candlestick appearing in the middle of nowhere doesn't automatically mean buyers are about to take control, but that same bullish candle appearing after price sweeps an important low and strongly rejects it can tell a completely different story. The difference is context, and context begins with understanding liquidity. Liquidity is one of the most important concepts in this entire strategy. At its simplest, liquidity represents the availability of orders that allow buyers and sellers to transact. For large market participants, finding enough opposing orders to execute substantial positions efficiently can be extremely important. Now look at a chart and find an obvious swing high. Ask yourself where traders who sold near that high might place their protective stop-loss orders. Very often, those stops will be positioned somewhere above the obvious high, creating an area where orders may become concentrated. You can apply exactly the same idea below an obvious swing low. Traders who bought near that low may place protective stops underneath it, creating another potential concentration of orders. This is why previous highs and lows can become extremely interesting areas to watch. Now we get to the first major part of the strategy, the liquidity sweep. Imagine price approaches an obvious previous high and suddenly pushes above it. Retail breakout traders may interpret that move as confirmation that price is going higher, while traders holding short positions may have their stops triggered. But instead of continuing higher, imagine price quickly falls back below the previous high. That failed breakout tells us something important. The market attempted to trade above the level but could not sustain that move. The sweep itself isn't a sell signal, but it gives us information that we can combine with what happens next. For a bullish setup, the logic is simply reversed. Price may sweep a previous low, strongly reject it, create bullish displacement, and then break above a meaningful short-term high. Now you have a sequence of events rather than one isolated signal. Think about the difference between these two approaches. One trader sees a level and immediately enters because a candle looks bullish or bearish. The other trader waits for liquidity to be taken, watches the reaction, and then waits for structure to confirm the direction. Now let's talk about displacement. Displacement is essentially a strong, decisive movement away from an area, often represented by large candles and a rapid breakthrough nearby structure. It gives us evidence that one side of the market may have gained significant short-term control. For example, price might sweep a low and then suddenly move upward with 3 or 4 strong bullish candles. Rather than chasing those candles, we can wait for price to retrace toward a logical area created during the impulsive move. One concept traders often use here is the fair value gap or imbalance. But don't treat an imbalance like a magical zone that price must respect. Think of it as an area of interest created by aggressive price movement where a retracement may offer a more controlled opportunity. The market can still move straight through it, which is why the entire sequence matters more than any single concept. Now let's put everything together into one repeatable framework. First, identify an obvious swing high or low where liquidity may be concentrated. Second, wait for price to actually sweep that area instead of chasing the initial breakout. Third, look for strong displacement away from the swept level. Fourth, wait for a meaningful market structure shift that supports the new direction. Fifth, allow price to retrace instead of entering after an extended candle. This gives you a much more structured entry model. You're no longer buying simply because a candle is green or selling because an indicator crossed a line. You're waiting for several pieces of market information to align before putting your money at risk. Now we need to answer one of the most important questions: where does the trade become invalid? Your stop loss shouldn't simply be placed at a random number of pips because someone told you that 20 or 30 pips is the correct amount. Instead, your invalidation should be connected to the logic of your setup. For example, in a bearish liquidity sweep setup, the swept high may represent an important invalidation area. If price returns above that high and begins accepting prices there, your original bearish idea may no longer make sense. For a bullish setup, the same logic can be applied beneath the swept low. Now let's talk about taking profit. If liquidity helped us understand where price might react, it can also help us identify potential areas where price could encounter opposing orders. Previous highs, previous lows, session extremes, and major structural levels can therefore become potential target areas. Suppose you've entered after a bullish sweep and structure shift. Instead of hoping price keeps moving forever, you identify the next meaningful high where liquidity may exist. This gives your trade a predefined destination rather than leaving the exit to emotion. This brings us to risk to reward. You don't need to win every trade to become profitable, because what matters is the relationship between your average winners, average losers, and win rate. A strategy that risks 1 unit to potentially make 2 or 3 units can survive a significant number of losing trades if the underlying edge is real. But there's an important warning here: a high risk-to-reward ratio doesn't automatically make a strategy profitable. If your entry has no statistical edge, simply targeting a huge reward doesn't magically create one. There's one more layer that can make this framework much more powerful: multiple timeframes. A beautiful setup on a 5-minute chart can fail because price is sitting directly beneath major resistance on the daily chart. The higher timeframe gives you context, while the lower timeframe helps you refine your execution. Think of the higher timeframe as your map and the lower timeframe as your GPS. First, identify major highs, lows, trends and important zones on the higher timeframe, then move down and wait for the liquidity sweep and structure confirmation before considering an entry. Let's walk through a hypothetical bearish example from beginning to end. Imagine euro to US dollar approaches a major resistance area on the 1-hour chart while price has already started showing signs of weakness. Instead of selling immediately, you wait for price to reveal what it wants to do around that resistance. Price then pushes above the obvious swing high, triggering liquidity above the resistance. A few candles later, price falls sharply back below the level and creates strong bearish displacement. Now you move to the lower timeframe and wait for a meaningful break in bearish market structure. After the structure break, price retraces upward toward a logical entry area. You enter only after the conditions you've defined are satisfied. Place your stop beyond the invalidation level and identify a potential target near the next significant liquidity area. Now the trade has a clear entry, a clear reason for being wrong, and a clear destination. Now here's the part that separates serious trading education from fantasy. This strategy will lose trades. A liquidity sweep does not guarantee a reversal, and a structure break does not guarantee that price will reach your target. Sometimes the market will give you what looks like a perfect setup and then immediately invalidate it. Your goal is therefore not to eliminate losing trades. Your goal is to make sure each individual loss is controlled and that your strategy remains profitable across a large sample of trades. If it genuinely has an edge, that means risk management isn't an optional part of the strategy, it is part of the strategy. So, what is the Forex strategy banks don't want you to know? It's not a secret indicator, a guaranteed pattern, or a hidden button that tells you exactly where the market is going. The real lesson is to stop looking at Forex as a collection of candles and start looking at it as an auction where liquidity, orders, positioning, and market structure interact. The framework is simple: find liquidity, wait for the sweep, watch the reaction, confirm the structure, wait for the retracement, define your risk, and target logical areas. Don't blindly copy institutional traders, because their execution, capital, objectives, and constraints are completely different from yours. Instead, use the information visible on your own chart to build a repeatable process and then test that process with historical data and a demo account. So the next time you open your chart, don't immediately ask, "Where should I enter?" Ask yourself, where is the liquidity? What happened when price reached it? Has structure confirmed the move? And where would my idea become invalid? If you can answer those questions consistently, you're no longer just hunting for signals, you're building a trading framework. And remember, this is educational content, not financial advice, and no Forex strategy can guarantee profits. Backtest the setup, record your results, Practice on a demo account, and only consider real money trading when you understand the risks involved. If you want more videos breaking down Forex price action, liquidity, market structure, and professional trading concepts in a simple way, subscribe to our channel, and I'll see you in the next video.